Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, as more and more data comes out from various news agencies and various technical firms, what we're starting to see now is a lot more patterns of the 2008 and 2007 housing market bubble. So what I'm going to do today, you guys, is I'm going to unpack some differences of 2008 versus 2022, and we're going to look at a couple metro areas around the nation that I believe and other economics believe that is severely overvalued right now. And the reason I want to bring that to light, you guys, is just in case you can move wherever you want. There's a lot of people that can now work from home. So in my opinion, y'all, it has never been more important time to choose carefully where you're going to live next, right? And work with the right professionals that understand how the housing market works. So what we're going to do today is we're going to deep dive into an article by Yahoo Finance called Housing Bubble 2.0. Regional housing markets are beginning to look like they did in 2007. So we're going to unpack that article, guys, but just remember, I am not a financial advisor. I'm a YouTuber. I'm sharing with you guys my opinions, a little bit about my experiences. Yes, in my career, I am a loan officer in Texas, and I am a realtor in Houston. And if you guys can, please like this video, subscribe to my channel if you haven't already. And as always, you guys comment below. I learned so much insights from your guys' comments. We have some really, really smart people in our community, and it's growing really rapidly. So please, guys, continue to comment. Let's get started on this article right now. Okay, the article goes on. When the US housing bubble burst more than a decade ago, it brought the global economy to its knees. It turned out that the multi-layer housing boom through the early 2000s was hiding skeletons. Home buyers, driven by fear of missing out on home price gains, were stretching themselves well beyond their financial means. And I'm talking about 2008, guys, not right now. And zealous lenders were giving out mortgages to folks who historically wouldn't have qualified. As that credit rushed in, it helped to drive the housing boom. However, as the housing market corrected, those bad loans created a foreclosure crisis that took many of the nation's biggest financial firms like Bank of America and Citigroup to the brink. It continues. Fast forward to today, where the US housing market is once again going through a historic housing boom. Over the past 2 years, US home prices are up 34.4%, including a 19.8% jump over the past 12 months. That 12-month hike is more than 4 times greater than the historical annual average of 4.6% that has been posted since 1987. It's also well above the largest 12-month price jump, which was 14.7%, posted in the years leading up to the 2008 financial crisis. So by now we understand that there's a lot of differences between 2008 and 2022, but I want to talk about what are the similarities, okay? So just like in 2008 right now, guys, we have the fear of missing out. So in 2008, great deal of fear of missing out, but also in 2008, there was a lot of easy access to money. And what I'm saying, you guys, similar to 2008, even though our lending guidelines right now are much stronger than they are in 2008 because of the Dodd-Frank Wall Street Reform Act and the fact that qualified mortgages are now in effect, the problem is in 2020 and 2021, money was very cheap and easy to get, just like in 2008. Even though the lending guidelines are different, so many people got free money and cheap money. So what I'm saying, guys, is even though 2008 is much different, look at the similarities on how easy it was to get money for housing back in 2020 and 2021. And the real big problem here, unlike 2008, in 2022, we have historical out of control inflation. So it is a lot different than 2008, you guys, but I'm, quite frankly, I'm nervous about the housing market that we're currently in. And the reason why I'm so nervous is because there has never been a year over year massive equity surge like we had right now of 19.8%. Right before the crash, the equity jumped up 14.6% or roughly 14%. So we, in my opinion, are in a much bigger housing market bubble than we were in 2008 because, quite frankly, once again, the massive equity surge is breaking the fundamentals and not matching wage growth. And that right there is the biggest issue. But let's continue on with this article right now. Okay, guys, this is a little bit of a long read, but hang in there because I really think this brings up some good points and good talking points. Now, the article continues. Our ongoing housing boom has more economists pondering the most feared word in real estate. It should be foreclosure, but it is bubble. In March, researchers at the Federal Reserve Bank of Dallas sent chills down the spines of home builders and real estate agents when they released a paper titled Real-Time Market Monitoring Finds Signs of Brewing U.S. Housing Bubble. However, if a housing correction does come to pass, the Dallas Fed researchers don't think it would cause a macroeconomic issue like we saw from the last bubble. Unlike the last go around, they write, household balance sheets today appear in better shape and excessive borrowing doesn't appear to be fueling the housing market boom. The article continues. That said, some regional housing markets could be in a full-blown housing bubble. At the very least, many markets are priced exuberantly compared to what local income levels can support. Each month, researchers at the university calculate how overpriced or underpriced home prices are in America's 100 largest housing markets. In their own words, here's how the Florida Atlantic University researchers say to read their housing analysis. A positive score represents a premium, implying that the average property in a metro area is selling above its historical implied price. A negative score represents a discount, implying that the average property in metro areas is selling below its historical implied price. So I would definitely agree with this article, you guys, on the fact that in 2022, households appear to be in a much better position financially than in 2008. But also what I'm saying is that's going to start to end because unlike 2008, you guys, what do we have right now? We have historical high inflation, right? Unlike in 2008, we basically didn't have really too much inflation at all. Fast forward today, we do have inflation. And I believe that these households are in such better shape, you guys, because the last 2 years, we got so much free money. So why wouldn't houses be in great shape? We got how much free money did we get from the federal government, from the Federal Reserve? We got a lot of free money, but you guys, here's the thing. This is our forward indicating things that I'm looking at that is essentially, that's why I'm projecting the things that I'm projecting. Now that we don't have free money and now that inflation is starting to kick our butts and it's all over the place, I believe that those strong households that this article is reporting on is going to be greatly impacted moving forward. So I want to watch out for that. And that's why I'm always preaching to you guys. Number one thing you should do, monitor your budget, right? Know where you're spending money. And then after you monitor your budget, re-budget so you know how to save money. The thing is, if the housing market does crash, we could still be incredibly successful as long as we prepare for it. Let's continue on with this article right now. The article continues. At the latest reading in March, Florida Atlantic University researchers found every one of America's 100 largest housing markets overpriced relative to what economic fundamentals in the market would support. That includes 44 markets overpriced by at least 30%. That's wild, you guys. And 13 overpriced by 50%. How are we not in a bubble, right? And I'm not saying every area is the same. Obviously, I live in Houston. I'm always telling you guys, Houston is so much more stable compared to the rest of the nation. That's why I live here and that's why I work here. The article continues. The most overpriced markets are Boise by 75% overvalued. Austin, and I'm always talking about Austin being the new Southern California, Austin by 66%. Utah, 63%. Las Vegas, again, Las Vegas just can't stay out of trouble. What is with Las Vegas? 60% overvalued. Atlanta, another 60%. Those places have all seen an influx of new residents amid the pandemic's work from anywhere boom. That in part explains why home prices there have soared well above what local incomes can afford. All of the out-of-towners, you guys, I keep preaching that. It also raises the question, if a 2023 recession does come and employers finally have the economic power to force staffers back into the office, will those housing markets be at a higher risk of home price correction? And what I'm saying, you guys, is those places are definitely going to have a price correction and crash, especially because they rely on tech jobs. If you guys have been in the stock market, like I've been in the stock market, the past couple of days have been an absolute, past couple months have been an absolute nightmare for everything tech. So take Austin, for example. Austin is 66% overvalued, and not from the locals, it's from the mass migration of people moving to Austin, getting new jobs at these local tech companies. If those local tech companies take a hit through the recession, and I don't think we're going to be a recession in 2023, I think we can be in a recession right now. We've already had 1 quarter of negative GDP growth. But if those jobs if they start to lose those jobs in those high demand areas and those overpriced areas, I definitely think it's going to be a crash, because those areas are only supported because of the jobs, because of the increased income. If that increased income goes away, I'm really afraid for a lot of those people that purchased in those areas. And I really want you guys to watch that. Now let's continue on with the article right now. The article continues. What's notable about the ongoing housing boom is the whiplash. Just 2 years ago, the housing market was reasonably priced relative to incomes. In March 2020, only 9 housing markets were overpriced by 10%. Back then was the most overpriced housing market. As of March 2022, Spokane is now overpriced by 55%, which doesn't even put it in the top 5. So 55% overpriced. It's not even the top 5. Super scary, you guys. Well, 90 out of the nation's 100 largest markets are overpriced by 10% or more. You guys, there's a nationwide housing bubble. Let's continue reading. At first glance, one might assume the COVID-19 recession dragged down the March 2022 numbers. It didn't. Well, obviously, everyone was pent up and wanted to buy. Doesn't take a genius to figure that out. The ratios created by the researchers at Florida Atlantic University were essentially the same in January 2020 as in March 2020. Simply put, March 2020 is a good point of reference. The difference between March 2020 and March 2022 speaks to how historically fierce the housing market has been during the pandemic. In a matter of 2 years, we've flipped from a normal housing market into one of that is historically overpriced. And here's the thing, you guys, I'm saying that the whiplash is going to continue in the other direction, because I have been saying this over and over. The reason why we're in this situation right now is COVID. I believe that we're not going to be able to cool down this market. It's not going to be a soft landing because of the way the market was created. Now, remember what I'm saying. Not all areas. There are some metro areas that are still super strong, like Houston, for example, still super strong. But overall, you guys, I believe the housing market is incredibly weak. The only reason we're in the situation is COVID and free money, free and cheap money. Now that the free and cheap money is taken out of the equation, and it's noticeable because our economy is suffering with just not even a 1% interest rate increase. So I'm saying the housing market is incredibly weak. The economy is incredibly weak. And because of those reasons, we're not really going to have a soft landing, in my opinion. It's going to be more of a bumpy ride. It's going to be more of a whiplash effect. But again, you guys, not in all metro areas, but I believe in many metro areas. And I don't necessarily think Houston's immune to all of this. I just think that you're going to be better protected in areas like Houston. Now, let's continue reading this article right now. Okay, the article concludes. The last housing bubble was anything but even. As the housing market crashed through 2008, overpriced markets like Phoenix and Las Vegas got absolutely crushed. Not only were home prices in those markets booming, so was new construction. But as the market slumped, Phoenix and Las Vegas became oversupplied with sprawling new subdivisions. You guys, I remember that. It was like ghost towns. It was crazy. That oversupply drove home prices down faster and made the foreclosure crisis in those markets even worse. You guys, I remember that like it was yesterday. It was absolutely wild. The article continues. This time around, Phoenix and Las Vegas are once again among the most overpriced housing markets. In March 2007, Phoenix and Las Vegas were overpriced by 59% and 72% respectively. In Florida Atlantic University's latest reading, those two markets are nearly their previous highs as of March 2022. Phoenix is overpriced by 55%, while Las Vegas is overpriced by 60%. If a housing correction does come, Phoenix could quickly become oversupply. And you guys, I know it's hard to imagine us having a housing market with too much inventory, because we literally have almost no inventory right now historically. But in many of my videos, I've outlined numerous sources of inventory that we are going to get a surge in going throughout 2022. And with demand being crushed, I think that some metro areas and some markets are absolutely going to be oversupplied, and that will lead to a correction / crash, right? But there is no doubt right now it is not a full-fledged crash or a full-fledged cool down across the nation. It's still a very toxic seller's market. So we need to continue to pay attention to these things. Now, what I'm going to do, guys, is I'm going to conclude this video with some conclusions that I've made from reading this information. So in conclusion, you guys, I really just want to emphasize how important it is to follow the trends, right? Follow the trends for yourself. No one is going to care about your real estate investing more than you do. So it's really important to continue to empower yourself. We're in an age now where information is easy to get. So what I want you guys to do is start watching your local markets and watch for the trends yourself, because not all the metro areas is going to be the same. For example, I'm way more worried about Austin, Texas than I am about Houston, Texas. So again, you guys, it has never been more important to pick where you want to live, especially if you're lucky enough to work out of your house. Say you're able to work out of your house and move anywhere, and you live in California or New York. Why wouldn't you want to live somewhere where it's easier to live, where it's more affordable to live? So I think it's wise to move, especially from Southern California like I did. But the fact remains, you must decide where is the best place to live, because I want you to prepare for the worst. By all means, hope for the best, but don't go dark. Don't put your head in the sand. Keep following the data. And I'm not making these videos to scare you, to talk about doom and gloom. I'm making these videos to empower you with the data so that you can plan your life accordingly and win in this housing market. Now, as always, you guys, I really appreciate you watching this video, and I always appreciate you going along this journey with me. And if you're out there investing in real estate, I do wish you luck, and I hope you win.